Let's look at the data. Whether you are 25 years old and just starting out, or 55 and getting ready to retire, you are probably chasing the exact same financial dream. You want a safe portfolio that grows fast during a stock market rally, but doesn't instantly collapse when a major economic crash hits the headlines. To achieve this, most traditional advisors hand you the exact same outdated playbook. They tell you to build a generic 60-40 split using broad stock indexes and corporate bonds, and then they tell you to just sit tight and pray for the best over the next 30 years. But here is the structural flaw nobody wants to tell you. Standard indexing leaves you completely exposed to economic storms. When inflation spikes or interest rates shift rapidly, both stocks and standard bonds can drop at the exact same time. If you need cash to cover your living expenses during that down cycle, you are forced to sell your shares at an absolute discount, permanently destroying your capital base. If you want a portfolio that actually protects your lifestyle regardless of what the economy does, you need to step away from generic assets and master the umbrella law. Let's look at the three-tier framework that keeps your money safe in any weather. To build a bulletproof financial shield, we divide our capital into three distinct, specialized operational layers. The first layer is our growth engine. Instead of buying every single company in the market, this tier focuses strictly on high-margin corporate giants with clean balance sheets, massive cash reserves, and pricing power. These monopolies can pass rising inflation costs straight down to consumers, ensuring your core wealth expands faster than the rate of inflation during economic expansions. The second layer is our volatility shield. This tier utilizes specialized short-duration capital tools and floating-rate corporate assets that don't depend on stock market hype to function. When interest rates rise and regular stocks take a hit, these specific assets actually pay out higher distributions, providing a powerful defensive cushion that counteracts market drops. The third layer is our liquid cash engine. This tier is built using high-grade physical infrastructure and asset-backed distribution trusts that pump out steady, non-stop qualified monthly dividends. When you lock these three tiers together, you create a self-sustaining financial circle that captures upside while neutralizing downside friction. Let's break down the exact mathematical blueprint to execute this system based on your specific life goals. The beauty of the umbrella law is that it uses a modular setup. If you are a young investor looking for aggressive wealth accumulation, you deploy a 70-20-10 allocation blueprint. That means 70% goes directly into your growth engine, 20% into the volatility shield, and 10% into your monthly cash engine. This configuration maximizes your capital acceleration while maintaining a tight defensive safety net. But if you are a mature investor closer to retirement who needs immediate capital protection and predictable income, you simply shift the weights to a conservative 40-20-40 split. Now, 40% anchors your growth, 20% neutralizes volatility, and 40% pumps out massive, steady monthly payouts to completely fund your living expenses on autopilot. By shifting these internal levers over time, you never have to sell your core assets at a loss. The system automatically adapts to your age bracket while keeping your foundational wealth completely safe from institutional fee structures. The ultimate secret to keeping this weatherproof system running on autopilot is our strict rebalancing rule, executed exactly twice a year. When a massive market rally pushes your growth tier past its target weight, you don't just sit there and wait for the inevitable correction. You systematically harvest those excess profits at the peak. Then, you instantly roll that surplus cash into your volatility shield and monthly cash layers to scoop up reliable dividend-producing shares at a massive discount. Review the institutional risk disclosure on screen and in the description box before executing any financial changes. If you are ready to stop leaving your retirement security up to chance and build a real, adaptive wealth machine that thrives in any economic weather, hit that subscribe button right now. Stay disciplined, protect your capital baseline, and always track the data.